All right, let's go ahead and get started. We'll start off with the S&P 500. Just kind of look at some levels, expectations, and just talk a little bit about what we expect coming into the next few months of 2022. So first and foremost, as epic as this uptrend has been, we still only have three waves. I've said it. I think I've said this every week for the last several weeks. And assuming that this is the start, that June 16th was the low, and that we are starting a brand new uptrend through 2023 to 2024, this would only be the third wave of the larger first wave. And what I mean by that is, in order for this to be justified as that first wave, we would need to see a fourth wave pullback, then another fifth wave to new highs. And if we get that, we can start being excited. And we typically don't try to time corrections. That's just not really what we're trying to do. The reason why we're a little bit more focused on this coming pullback is because we only have three waves off the low. There's still, because there's only three waves, this still could be a bear market rally. I don't want to say yay or nay on that, because when we were down here, everyone was quite certain that it was going to continue. And now that we're up here, everyone's quite certain that this will continue. And, we're seeing sentiment extremes that we last saw in mid-2021. So we're ripe for a pullback, and that pullback will really tell us everything. The pullback will, the structure of it, if we go down in five waves, that tells me that this was the B wave and we're starting a C wave down. I don't see that happening personally without some kind of new catalyst. I think all the information that caused this bear market has certainly been priced in. So it'd have to be something new the market's not seeing. But let's say that we just retrace in three waves and then turn back up in three waves, then we have our first wave of a brand new uptrend. So that'd be fantastic. And our game plan would be, once that first wave is done, we then have a large degree second wave to contend with, which will most certainly take us back to the 4,000 region, the minimum, I believe. Not minimum, but around that region, and that would be the time to start really loading up. And then on the breakout above the top of the first wave is when you really go. I mean, that's when we'd probably go leverage if we were going to do that, because we'd be starting that third wave. But we're talking about big waves, like from June until right now, which is August. We're only halfway through the first wave, if this is what's going on. Okay, so this is the grid that I believe we're working off of. And these are the levels that seem to be where the market is really finding a lot of resistance and support, and so we're currently struggling around that 43.4295, which is right at the 200-day. I wouldn't be shocked. There's probably so many stops around the 200-day right now. I wouldn't be shocked if they run it up into 43.75 next week, just to stop everyone out, make sure no one's short before it gets brought back down. You see moves like that all the time. Investing is rarely as easy as we touch the 200-day and then turn back down. It could be, but I wouldn't be shocked if we take another run at it, maybe above it a little bit, just kind of hover around and make sure as many stops get hit as possible. But in terms of the structure of what that leading diagonal would look like, it'd be the blue count right here. So we have 1, 2, 3. We have a fourth wave, probably back into the 4170 region. I've raised the critical level for this to about 4020. I wouldn't want to see it go below 4045, but 4020 is the absolute lowest. If we break below here, then the 1, 2, 3, 4, 5 wave move that would suggest the bullish outcome, the long-term bullish outcome, would be off the table. And instead, we'd likely be seeing like a, then a B, and then one more C wave push probably into, fall, winter of this year, before we get that C wave down to new lows. So like I said, just the structure of this bounce is not decisive right now. If you're just going based off of just evidence to build the case, it's not there yet. but we're close. And if we can get that fifth wave, I mean, that's when, that would make for a really good 2023. We get really excited about that. But this is what we're looking for right now. So moving forward, I do want to talk about small caps because small caps have made such an epic move off the low. And you got to keep in mind, small caps really, they did make a new high right here in November, marginally, but they really have been in correction since March of 2021. I mean, it's a long time for small caps to be in a correction. And this is a pretty major correction in both price and time. And so it makes sense that we'd be getting some kind of a bigger push. I mean, the deeper down it goes, the more extreme the up move can go. And that's what we're seeing right here. We're basically back at the 200-day, broken through the bear market resistance, but still only have 3 waves up. So if small caps can give us a 4 and a 5, based off of where the targets we have for this final 5th wave right here up, we'd be looking to probably do some kind of a leveraged small cap play on the 3rd wave breakout, but we'd be looking to add to our small cap plays on the 2nd wave retrace if we do get that 4-5. But we think small caps would be a fantastic opportunity, if we do get that confirmation just based off this move right here. And keep in mind, this is only the 3rd wave of the 1st wave. So a lot of people think that they missed out. That's just not the case. Certainly not the case. Market's moving 5 waves. You really want to be fully invested for the 3rd. Right. And so you're experiencing the 3rd wave of the 1st wave, right? Imagine the FOMO you're feeling right here. Imagine that on one scale higher. And that's what we really want to be prepared for, right? This is just not enough information to get fully excited that we are in a new uptrend. Once we get the 4-5, then a 3-wave retrace, then we can start getting really excited and building our positions heavily down in this region right here. Okay, so some interesting developments. The 3 macro assets, commodities that are really pushing equities. Rates, I think, are the big one. And what I find very intriguing about rates is, if you look at what's coming out around inflation data, I mean, we just got the Philly Fed data came out today, and it was showing a continuation of inflation trends have peaked, a continuation of that trend. Housing data continues to suggest that. Even the Federal Reserve's tone is getting less hawkish, So, and at the same time, we're hearing the ECB talk about getting aggressive with inflation. And all these things, should suggest, inflation is easing in the U.S., we should see the dollar continue to go down, and we should see rates continue to go down as bond investors buy bonds with great yields as we go into a slowing growth global economy. But that's not what we're seeing. We're seeing the bond market's just simply not buying what's going on right now just yet. So if we would have broken out above this is long dated bonds, and if we would have broken above that 123 directly, then that's the bond market saying they believe the Fed inflation is probably coming to an end. And now we got to contend with slowing growth, which would definitely, put a bid under equities based off how extreme rates have gone in this move down. But we're not seeing that yet. We're not seeing the buyers step in to rates. And so that's a little concerning. The 2 paths that I see playing out, I've talked about this quite a bit, is that we just completed a 4th wave and we have a 5th wave down to like the 106, 105 region. That would definitely put pressure on equities as rates hit an all-time new high, but it would probably be done on much less volume and much less momentum, being a classic 5th wave. And that would be probably the final move in this move before we get that buyer stepping into bonds again. The other scenario, and you see how overlapping this isn't a clear 5-wave pattern, which is why I put this in here. If it was 5 waves down, 3 up, then we know we're going down for that 5th wave, but we don't have that. It's very overlapping right here. And so what that's telling me is that this could just be the B wave of this larger A wave. So we have A, B, and then C wave up to here. And that would suggest that this was the low for bonds and that rates have peaked, but they're doing so in this kind of overlapping corrective fashion. Once again, it looks like we're setting up for one more drop down into the 112 region. You can see how this level is holding, but the kind of a descending triangle pattern right here. So I'm looking at 112, and I really want to see 112, 113, 112 hold below there, and it starts building the case that we have one more low to go. So rates basically are just not buying what the Fed and what the inflation data is telling, what the equity market is thinking is going on, if you will. Another thing I find concerning is the U.S. dollar. And we talked about this for the last several weeks. This 53 level is very important. Support in the uptrend, all of a sudden it's resistance. We had our first waterfall moment, breakdown, and they couldn't hold it. The bears couldn't hold it, and it got reversed. This is a pretty classic false breakdown. And then buyers stepped in heavily. And you got to think about this, with all the information coming out about inflation, with the ECB getting more aggressive on inflation, with the Fed getting less aggressive on rate hikes, what is the dollar picking up on? Is this a corrective rally? It could just be a corrective rally, but if it's not, what drives the dollar is usually a fear. A fear is typically when there's a lot of fear, the dollar gets bought. The other thing that will drive the dollar is obviously going to be rate hikes, but they go hand in hand with fear in the equity market. So this is a little concerning. We've taken back 53. Bulls have stepped back in. So if we start breaking out above this like 107, 108 level, then we could have another high on our hand. I do think that we are close to putting in a pretty long-term top. I've talked about this before, this 45-degree line from 2008. We touched it perfectly and fell back, but it's going at a 45-degree angle. So we could make a marginal. We could make another run at it and test it again, maybe at 109, 110. Before coming back down, but that would also put pressure on equities as well as crypto. The thing about crypto and DXY, the dollar index, it's not a perfect correlation. They don't bottom and top on the same days, as long as it's like kind of a low volume, low momentum uptrend, I don't think it's anything to get too concerned about, but it would put pressure on equities over the short term. And the last thing is crude oil. We've talked about this before. This is a very clean and clear ABC corrective pattern, which I believe is part of a bigger uptrend. This is a diagonal C wave. And as you can see, it looks like we're going to break out right here, fell back down, holding this $86 level, $86, $87 level. Could make one more low down into 82. However, the selling momentum is greatly fading, and the divergences are building and building and building. Once we break above 94, this downtrend is over, and I believe the pressure will start building to the upside. And once again, it kind of gets back to what is the oil market sniffing out, what's it predicting, so we'll have to see what's playing out. But I wish it was the opposite. I wish it looked like oil was in some kind of long-term holding pattern or some weak uptrend, and the dollar was certainly reversing and continuing its downtrend, and the rates were going up. If that were the case, that'd be a reason to try and front run a lot of what we're seeing right here. But just keep in mind, with all the things I talked about on the macro scale, we still only have 3 waves up, okay? And I know FOMO is quite big right here, but we only have 3 waves up, and the 3 assets that have been driving this bear market are not fully participating with the uptrend yet.